Hi, everyone. Welcome back to the Teens for Business podcast. I'm your host, Kylan.
I'm Jack.
I'm Jackie.
And I'm Ivan.
And today we'll be talking about our economy's recent growth with inflation rates falling. But first, a quick segment that I want to go back to with the NFL playoffs underway. What are your thoughts on today's games with the Chiefs, Ravens, and Niners, Lions?
I can go first. Oh, for the NFC, I'm definitely sorry guys, but I'm kind of rooting for the Lions. I feel like the Niners will win, but I just something in my heart is like, yes, go Lions. But honestly, I like both of the teams. Like, I do super fine with them winning. Like, I like both of them. On the other side, though, I dislike both of the teams on the AFC. Being a Bengals fan, like the Ravens and the Chiefs are just not it for me. And it was funny because I live in Maryland, but. Honestly, I think if I had to choose one, I would want the Chiefs to win. And I know that's like a probably very unpopular opinion around the United States right now, but if someone had to win, it would be the Chiefs. But honestly, not a fan of either. Um, but I feel like the Ravens will win. It's just that like I don't know if I want them to win. That's the thing.
Yeah, on the NFC, I should predict Lions to win because just how shaky the 49ers looked against the Packers, which were pretty big underdogs in that game. Until the last drive, the 49ers were dominated pretty much, and then they got very lucky. So we'll see. It'll be interesting to see how that game turns out. I think there is I'm personally rooting for the Lions, and I do think they will win, but I know Ivan will disagree with me. Anyway, on the AFC, I want the Ravens to win just because the Chiefs have made the Super Bowl over the past several times over the past super few years, and I do think the Ravens have the power to win because they look really good in the second half that they played against the Texans, even though their first half their offense was a little bit rusty, but it's okay. But I do think the Ravens will move on to the Super Bowl, and if the Ravens do play the Lions, I would root for the Lions in the Super Bowl, but I think the Ravens would win that. But if Ravens v 49ers happens in the Super Bowl, I would go for 49ers.
Yeah, so me personally, I'm a believer in the NFL script. So I think the Niners will win and the Ravens will win according to the script. But since the NFL discovered that we realize it's a script, I think they're gonna switch it up on us. So there's actually a high chance that Lions will win and the Chiefs will win. But me personally, I think the script is still gonna go the way it is.
Yeah, last week against the Packers, Niners weren't good, but I think that's because Purdy in the rain that never goes well. So hopefully we can come through this week. But yeah, I think I'm gonna go with Ravens for the AFC just because nobody likes the Chiefs, but yeah. So Niners Ravens Super Bowl. Um, yeah, I think the two favorites are probably going to the Super Bowl. But back to our main topic. So many economists basically spent early 2023 trying to predict like a painful downturn with our economy, but like on the other hand, inflation like spiked to the highest level in decades, and a range of forecasters thought it would take a drop in demand and a prolonged jump in unemployment to wrestle it down. But the economy actually grew 3.1%, which is up from less than 1% in 2022 and faster than the average for the 5 years leading up to the pandemic. So inflation has retreated substantially, which is very contrary to what these economists were believing. And unemployment rates actually remain at historic lows while consumers continue to spend even more money with the Federal Reserve interest rates at a 22-year high. So the thing is, like, why do you think the Fed has been hesitant to cut rates even with our economy kind of doing like super well right now?
So yeah, I can start this one off. I think over the past 4 years, especially since COVID started, inflation has been really impossible to predict. Like in the year that we predict inflation, all of a sudden we have deflation, like what happened early in 2020. But then when we predicted more deflation, instead we have all-time inflation, which happened over 2021 to 2023. And now we're seeing the same trend in 2024, which we think is going to happen with the recession. And now in now there's a growth in the economy. So just because of that reason and just because of that insecurity and what we see going on that what is going on in the economy, I don't think that Fed officials are not convinced that inflation will continue to slow down. And there's a lot of evidence that their caution is warranted. So the U.S. economy is like showing a lot of signs of resilience with this growth. And I think maybe right now that cutting rates aggressively is would pose a very big risk to stall or reignite big time inflation that may plague the economy in the future.
Yeah, and I think something important to remember is that the Fed really wants to get a soft landing, which is kind of a situation where the economy slows down, leading to inflation decreasing, but there is still no recession, which is very hard to achieve and has only been achieved like only a few times ever in history. So the Fed is trying to do that because obviously you don't really want a recession, so that's why they're so hesitant to cut rates because even though the economy is so good, they still want that soft landing. So because if they immediately start cutting the rates, then consumer demand will go off the charts, and then it will suddenly lead to a very big recessions in the near future, which is not something the Fed wants. Um, but I think the Fed is actually achieving their goal of achieving a soft landing because um while they were raising the rates, obviously the economy is slowing down. But now they're holding still. The economy is kind of remaining the same, even when there's high rates or even if the rates are held at the same place. So I think if they gradually start lowering the rates, probably this year or in the near future, then the soft landing might be possible for the Fed.
Yeah, I definitely agree with what Ivan and Jack have been saying. So for some like news, I guess, with what's going on. So today is January 28th, but if we look at it from this way, this is like Tuesday, like this week at least, there's gonna be like the Fed, they have like their whole like policy meetings, like their 2-day policy meeting, like Thursday and Wednesday, I think. And so I'm like if you look at like what a lot of like analysts and top like people are kind of predicting. So as like Ivan and Jack were talking about, a lot of people are predicting that the Fed kind of remain like neutral in their stance. And people kind of just expect it because like right now it's still like at a very, very high like rate. So people just expect it to be neutral, and that kind of like ties into what we were saying before. Like if there was like a drastic like turn in either direction, then they wouldn't be able to achieve what they want to. And so I think it's going to be interesting to see what they do choose to do on Tuesday and Wednesday.
Yeah, definitely. I agree with all 3 points. I just think that like with the US economy, because like the US economy is still showing signs of resilience, it's still being like it's still strong here. Like cutting rates too aggressively will basically pose the risk of stalling or reigniting inflation. And because we've had like this disinflation so far, that's occurred has been in like these good prices. So supply chains have basically normalized and transportation costs have come down. So if you try to cut rates like too aggressively, the inflation's going to come back up, and that's going to just basically it's going to ruin what we have going on right now. So the Fed is trying to figure out the best way to attack that. And just moving on to the next question. So like with many economists kind of predicting this recession in 2023, the economy ended up growing a decent amount. So what do you think were the factors that led to these like wrong, incorrect predictions? And yeah, like why did they turn out to be wrong?
Yeah, I think that a main factor is that like many economics assume that since the Fed had increased like the interest rates to like a level that is like considered far beyond safe for the economy, it was at an all-time high. And as like inflation would slow down, like the economy would enter recession due to these like high rates, so that the Fed would have to cut them down aggressively. Obviously, that is not what happened. As right now, like since because of this disinflation that Kyvan has mentioned, there's a big spike in like consumer spending because obviously they couldn't spend all that money to get what they wanted during the times of inflation. So now consumers are purchasing more, and that is spurring economic growth. But we could definitely see that the predictions came from like potentially the risk of like the Fed um spiking interest rates at all-time highs last year in 2023. I think another factor that I'd like to mention is the global freight recession, which is still ongoing and China is still like kind of like struggling with that. And China is still one of the major trade partners with the United States, so that definitely also plays a role.
Yeah, I definitely agree. I just want to like kind of play devil's advocate a little bit because I think the economy looks better than it actually is. Much like in China where the economy doesn't look bad, but it's actually way worse than what the numbers say. And I think it's probably the same in the US too, because first of all, like even though inflation is not going out of control and the labor market looks good based on numbers, but actually I think a lot of people, especially the middle class, are not doing as well as you say like 3 4 years ago, because simply because even though the labor market, there's so many thousands of jobs being added every single week or something, it's just nobody wants to work those jobs. And of course there's going to be some people who takes those jobs, but you can see like the tech companies, the large tech companies, like the largest companies in the US and in the world, they're laying off thousands of employees every single month. And people still say the labor market is strong, and I actually doubt that, because you know all the people who were driving the IT revolution in the US, all the driving the tech force in the US are getting laid off, and they are not working anymore. Like people working for Meta, Amazon, Apple, Google, they're getting laid off because their jobs simply, like, a lot of the jobs getting laid off are part of like Google Home or Amazon Alexa, simply because the rise of ChatGPT, and these tech workers are not gonna find any jobs, and they're getting handed like packages, get laid off, and then some people will just say, okay, then I'll just not work for a year. So I think these are hidden unemployment stats, and I think the numbers actually look way better than it actually is. So I think we need to take these numbers with a grain of salt.
Yeah, I definitely agree with that point. I think also just to play like a little bit more devil's advocate here, but like for something like we can all like notice, that's not like so economic centric or like policy centric. I think like shrinkflation, for example, like if you go into like whatever store, like the grocery store, for example, you'll see like a lot of the products, like even the technically the prices, like they're not raised, or like they're raised like very, very little. Like the quality that they give you and like the amount of things, I guess, in the product they give you is like just decreased a lot. And I think like that's another thing of like what Ivan was saying about how like things look fine, or like we don't notice it as much, but like just little changes in the economy, and like that kind of was happening in like the height of like 2023. But I think like the effects of it still definitely carry over to 2024. And like the foreseeable future, I don't think that's gonna like change, because like manufacturers don't have any reason to, or like they wouldn't have an advantage to like change that, because if they can like shrink it without anyone noticing, then they're not gonna have a reason to like go back to what they were at before. Um, so I think definitely that's like one of the things, like just like a little sneakier way of seeing it. That's not so like policy, like Fed rate centric, or like looking at like financial markets, things like that. So I just wanted to point out how it's like very still obvious, I guess, in our own everyday lives.
Yeah, definitely. I think that like it kind of started back in March 2022 when the Fed started rapidly increasing those rates. So they made everything more expensive, like from buying like a house or to like expanding your business. They just wanted to force companies to stop raising prices, and these factors usually lead to a recession. But like our economy kind of it never fell off a cliff, but it rather like it started gradually, kind of gradually falling off, where like hiring kind of slowly fell off, and then prices started slowly rising. But it's just never fully like I never fully like fell off that cliff. So I just think that's pretty interesting that even with the rapid interest rates like increasing all the way back in 2022, in 2023 we really haven't like seen that crazy recession that we kind of experienced previously when seeing those rate increases. So I guess how does interest rate cuts impact investors and the general market?
Yeah, there are two ways that I have like identified like how interest rate cuts could impact people. Like, first of all, as an investor myself, I've seen that the interest rate cuts have actually helped stock prices to increase like more because like as a result companies can like invest more into products, investment spending, and it'll help them become more efficient, more competitive, and potentially even richer. And as an investor myself, I'm gonna mention Nvidia because it has done really well this year so far. I have actually got like a lot of like investment off of like Nvidia, so it has been doing very well so far. And Nvidia's success currently in the early stages of 2024 is a perfect example of what interest rate cuts have been like kind of like doing to like Nvidia's allowed to like spend more and like invest more to become like to improve like their product. And also, interest rate cuts also like encourage like consumer spending because like decreasing prices that just means like consumers can spend more, which end up leading to like economic growth. And I think a caveat of this is that if like the interest rates keep getting cut or cut aggressively, we need to like watch just to make sure like the consumer demand isn't at like super high and like the the supply needs to be like able to like handle that consumer demand. If the supply is like compared to like consumer demand, if the supply is like super low compared to like a big high like consumer demand, we could see the economy go into recession really quickly.
Yeah, I definitely agree. I think for the main part, interest rate cuts, um, I think it all starts with lowering the cost of borrowing, which is I think the fundamental of economics and interest rates is when you lower interest rates, everything related to that interest rate drops. Like borrowing using credit cards, those rates will also drop, but then also your bank account rates will also drop. So they think that's like the general kind of idea is like you don't want to keep your money in the bank account because it's not getting enough money anymore. But then you also want to borrow because it doesn't cost a lot to do that, and that kind of tends to drive you know consumer demand a lot, and that's why typically I think in an ideal situation, that's how in- cutting interest rates can boost your economy but also increase inflation. But it's still ideal society. I think in the current U.S. economy, I think if even if you cut interest rates, I don't think anything would change simply because um the stock market's doing relatively well, and every I think a lot because of the access to internet, a lot of people can understand economics, can understand what the motivation of the Fed is, as compared like 50 years ago when this information was not readily available. So I think our current society is far from ideal, and I think this current ideal situation when you cut interest rates and everything starts jumping around, I don't think that will happen because everybody understands they're cutting rates to drive demand, but what if I invest in this thing to make sure I'm still getting that high rates and I keep my money secure, right? That's information is all readily available now, and I don't really think cutting rates will actually lead to a very large recession in the future, simply because our consumer demand jumps a lot in when you actually do cut the rates.
Yeah, I agree. Another thing I wanted to point out was that like when we kind of look at this, it's not just like oh like 2023 thing. It's like there's a lot of like trends going on. And I think like definitely, even though technically it's been like 2 to 4 years since it's happened, the COVID, and then we look at the Russian and Ukraine war, like when that started in 2022. And then Kaiwen mentioned the date mark of March of 2022. And that's kind of when there's like a series of like quick like rate increases by the Fed. And like once you look from that and like starting from like 2022 of March and then like all those like quick rate increases and then you get all the way like through 2023 and then like 2024, which like we're in right now. But I think like when you look at that, so like a lot of what's happened before, like historically, when you put like high inflation together and then like rate increases, which the Fed was doing, that's historically has yielded to a lot of like recession. Sorry, I like lost my train there. But like that's like leaded to recession. And so I think like that's like one reason why economists were looking at like, okay, I think something's gonna happen. But then just the US economy did not go that way. But that kind of answers the question of why did that even happen in the first place? And then I definitely agree with what Ivan and Jack were saying about like especially Ivan's explanation of like what the rates were, like the fundamental changes, like how, like if you cut rates, what happens, and then if you increase the rate, what happens.
Yeah, definitely. And I guess like with that being said, like do you guys agree like that it is too risky to cut rates right now, or do you think that maybe the Fed should just jump on and cut rates because consumer spending will increase?
I think it kind of depends because like consumer spending is obviously doing really well right now, but if you cut rates too aggressively, it could like lead to like a downturn. If you cut like rates like small at a time, it won't do that much change, just like Ivan said. And obviously we see the economy right now is in a really unique situation. While like consumer like spending is like really high, you can also see like unemployment, even though like it's kind of being covered up by technology and AI because AI has become like so powerful. And for big companies like Google and Amazon, certain AI advances have allowed Google and Amazon and those like big companies to replace features that aren't doing as well. And since like those Google and Amazon have like teams that are like catered towards those certain features that aren't doing that well, they can be just cut and that leads to unemployment. And some other examples of like our spin-off AI companies that actually took advantage of ChatGPT, what ChatGPT didn't have, which is like, for example, the fact that they couldn't upload PDFs and images, but now ChatGPT obviously added that feature, which basically eliminates like the customer base for these like big smaller companies with like just like smaller additional features. So I think it isn't I don't think it is that risky to cut rates by like small portions just because of like even though like consumer spending is like super well right now, the unemployment situation isn't also that ideal. So I think that the US economy is in a really unique situation and that the Fed will need to be careful in what they do in the future. So small cuts in I think rates should be okay due to like the trajectory, but big cuts and aggressive cuts are obviously are kind of dangerous.
Yeah, I definitely agree with all of what Jack said. I think wanted to highlight that um kind of like if when you cut going back to like the fundamentals, when you cut rates, you expect consumer demand to increase, the inflation to increase. But I think when the Fed will cut rates this time, um as I said before, like the since we know everything based on the internet, a lot of people know more compared to, let's say, a decade ago. But I want to add on to another point because, as Jack said, like a lot of the tech workers and the middle class workers are not they don't have a job right now. And a lot of the people's jobs are on ice. Um, like I think I recently saw a video of I think it was Amazon interns. Um, they're not getting return offers simply because Amazon had a hiring spree during like 2020, 2021, and then now they have way too many workers and trying to lay off those workers. And so I think a lot of the big spenders in the economy, like the middle class in the US is actually huge and it has the potential to grow even bigger. Um, but these tech companies, they don't really want these workers anymore. And as you see with the union works, a lot of a lot of these companies, large companies within the US, a lot of people's jobs are on ice, and I don't think the numbers can accurately reflect that risk because these people who spend a lot of money in the market, they're not willing to spend that money because they're like, okay, if I spend a lot of money in this month and I get laid off immediately next month, what am I gonna do? So they're preparing for that risk of getting laid off. They want to still keep food on the table for their families. So I think the big spenders in the economy will not spend a lot, even if the rates decrease, even if the rate drop, even if it is expensive to keep the money in the bank accounts. They still want to play safe because their jobs are not safe. And so that's why I think it's actually not risky for the Fed to cut the rates, simply because the numbers just don't tell the entire story.
Yeah, I agree definitely. I think also the Fed, they announced that they expect to cut rates 3 times in 2024. But as Jack was saying, I do agree with that. If they like don't have any dramatic, as of like right now at least, like if they don't have any drastic cuts, like smaller cuts would be fine. But I think definitely like having like larger rate cuts would be more risky for the economy, especially because right now there's a lot of like uncertainty in what's been happening. Like for example, like what this entire podcast was about like why did the economy like not meet what people thought it would do. And so I think because of that happening, I think having like any drastic movement or dramatic movement would be quite risky. But I think like because they said that they do expect to cut rates 3 times in this year, I think like we can expect it definitely to happen at some point. But again, I don't think it's going to be anything too heavy.
Yeah, I agree. I think there's a reason they're definitely like trying to wait to cut rates a little bit. Like I mentioned earlier, like they're trying to keep that like a soft landing. And yeah, but like 2024, this is actually like an election year as well. So is this like is the election year depending on which president does get elected? Is that gonna impact the market, you guys think?
Yeah, just going back to just like something that you like mentioned, like it really does depend on what the trajectory and the predictions are regarding the political landscape. As of right now, I can't really tell who's gonna win, and I definitely think that it's pretty much the same for pretty much everyone, that it's pretty close between Trump and Biden. And as we have seen, Trump and Biden have very like differing economic philosophies. So during like Biden's tenure, his like economic moves can be like characterized by big government spending on like COVID-19 recovery, investments into clean energy, R&D, healthcare, and a giant investment into AI. And then all of these are helping the consumer spending, and which has definitely helped the middle class the most. However, on the other hand, Trump is proposing tariffs on imported goods and increasing constraints on goods that are specifically from like China and other countries that the US doesn't have like that good like relations with on a political scale. And he wants to make domestic industries more competitive and appealing. And as a result, I do think that the tariffs would actually raise prices, which would actually decentivize consumer spending a little bit. And as we've seen these like different like philosophies for the future economy, if like a certain candidate is like in the lead, I think whatever the economy would be, I think it would shift towards potentially tailored towards the philosophy of like the candidate that is in the lead or has a good chance of winning. But as of right now, we obviously can't tell who that is. So I do think it could change by a little bit, but I don't think it won't heavily impact the market.
Yeah, I think Jack does have a point, but I think um for me, I believe that it's actually the other way around because the market is good, it's affecting the election year. And I think there's something called 13 keys, which is like 13 keys to determine who wins the election, and currently Joe Biden is not looking good because you know after Trump got indicted, after Trump was going to court, his numbers went up and Joe Biden's numbers went down. And a lot of people, are looking at alternative candidates, at third party candidates, especially Democratic voters, because, you know, they think Joe Biden is getting too old and they want some new candidate who will not potentially die in office. Um, so, I think and I think this kind of goes to the economic trends because everybody understands that both Trump and Biden are like pushing 80, 85, right? And regardless of which candidate gets elected, the presidential office does not look too good for the next 4 years. And even though the market will still go up because it's an election year, and the historical trends has shown like the S&P 500 has averaged a 7% gain during every single US presidential election year regardless of candidates. And if Trump gets elected, if Biden gets elected, their growth would be relatively the same. And there will be a boost in the economy regardless of which candidate gets elected, because simply by you only have two parties in the U.S. and which side gets elected, same amount of people will do the same amount of spending, etc. Right, and so I don't really think election years do have this election year will have a very large change in the stock market because this change has been reflected all across the years. And I think like Trump's claim of, oh, when he gets elected, the economy will go really high and it will grow a lot. I think that's just unfounded because he is only benefiting 10 people maximum, right? The billionaires paying like millions of dollars in taxes less than it used to before, and that those are the only people who are getting benefited, not anyone else. So I think it's just that's just a trend. It's because it's an election year doesn't mean the stock market will change a lot.
Yeah, I think those are quite interesting points. Um, I think Ivan was talking about how like the market affecting the elections versus the elections affecting the market. I think both there's like kind of like that like effect of like both of them affect each other. But one thing that I do want to mention is that a Trump versus Biden rematch, if that is what like actually happens between like two candidates, like obviously as you mentioned, like there are like kind of some discussions about like do we really want Biden to be like the Democratic presidential nominee versus like do we even want Trump to be that like for each party? But I think if does end up being Trump and Biden, there's a lot of like contention over that. And we also need to factor in like that social unrest aspect of it's like, okay, well, it's not just whoever wins like what they're gonna do, but also like what citizens of the United States are also gonna do and like what they think. If we think back to 2022 or 2020, there's obviously a lot of just like unrest and a lot of like people unhappy with the election results. And I think whichever way that happens this time, that might happen like whoever wins this time, like that unrest might happen again, or people aren't satisfied with the results. And so I think if there is like a lot of social unrest, that definitely will reflect in the market, especially with like stocks, things like that. And another thing to talk about is oil. So Trump is definitely like a little bit more pro drilling, getting oil, versus Biden and like the Democratic Party is more like they don't want as much of that because like environmental harms. And I think looking at that definitely could impact at least how the energy sector and like oil sector is doing. So I think just like differences in policies does affect it. Maybe not like immediately, but I think because the presidential term is for 4 years, and it is important to consider like at least 4 years in the future. I think there definitely will be like kind of differences in the market based upon like who wins the election.
Yeah, I definitely agree with all those points. And yeah, that's it for today. Thank you guys so much for tuning in with us on this podcast episode, and we'll see you back next week.